Hi, thanks for joining us for this MTA podcast. We're going to talk about the Career Services Committee and some of the options available as careers to market technicians. We're joined today by Kristen Hetzer, who is principal of her own firm, Royal Palms Capital. Is that correct, Kristen?
That's right.
And you started the firm just a couple of years ago?
Actually, just over 5 years. So it's
Can
been
you tell us just a little bit about your background? And I'm sorry to talk over you. Can you tell us just a little bit about your background and what led you to start your own firm?
Sure, I'd be happy to. Well, I started in the business back in the early 1980s, and it was right at the beginning of the great bull market in stocks and the bull market in bonds. So it was a really terrific time in history. At that time, I started as a registered representative or stockbroker, what we're normally called, for Merrill Lynch. And back then, Merrill Lynch put their brokers through, they were called account executives, and we went through a pretty rigorous training program. They'd send you back to New York City, and you'd spend a month on Wall Street. So it was really a great training opportunity, and I essentially was a registered representative for, I think, 24 years. And over that period of time, I worked from Merrill Lynch. I did work for Kidder Peabody for a couple of years when Ralph Acampora was there. And then I was at Prudential Securities for many years. What happened in the 1980s, of course, being at Merrill Lynch, and I do want to mention one of the things I did as a young, what's called rookie broker, I listened to Bob Farrell's technical call every week. And it was my job to make notes of what he was talking about and summarize his call and put out commentary to the office. So I think that was probably where one of the times that I got more and more interested in technical analysis. And then when I went to Kidder Peabody, some of the real old-time brokers were using, I saw a lot of point and figure analysis. So I'll never forget, after the crash of 1987, and I was interested in point and figure before that, so there were a number of signs that was very interesting during that year that we were in an interesting market. But I'll never forget, right after the crash, which was such a dramatic decline, there was a group of really old-time brokers, and I want to say they were probably been in the business 30, 40 plus years, and they were all huddled around a point and figure chart book and just kind of amazed that the indicators were at such a tremendously historic oversold level. And I knew that one particular gentleman had just made fortunes for people with the advice that he'd given clients over years. So it was a progress, and I started going to the seminars and so forth. So basically, I was a registered representative, and it's different in many, many respects from being a registered investment advisor, and I'll talk a little bit about that. But on the side, I had such an interest in the markets and in technical analysis and really figuring out how to best make money. And so as my career progressed, of course, I was giving recommendations, and you do have to, when you work for big firms, all the recommendations have to go through compliance, and some things, no matter how great they look, maybe the firm will say, well, you can't buy this. So there's always, within the large firms, there's tons of attorneys, and rightly so, and many obstacles, so you may or may not be able to execute your business the way you would like. But what happened in the 1990s, I was at Prudential Securities, and they came out with a program that you could be a discretionary manager within the firm. So by this time, I was pretty much giving advice as I saw it, doing a lot of my own research, and not liking having to call. A lot of times you recommended a very successful stock, and then it was starting to give indications that maybe it was good to take some profits, and then you'd have to call the client, and you have to do this for every person, and maybe you're calling 50 or 100 people, and it just got to be very laborious and not effective. So I really liked the discretionary management because for the most part the clients were listening to what I recommended and then taking my recommendations to sell or whatever according to whatever their particular objectives were. So I became a discretionary manager within the brokerage firm's overall operation. So that worked really great because I was able to establish a track record, and it's strictly a fee basis. So, and you can, of course, many guidelines which are appropriate. So anyways, I established a good track record, and we did make one more move. My husband and I had a business together, and we ended up at Payne Weber, which became UBS, and just really, I looked at the business one day, and of course, you're doing your own research, you're making your recommendations. The client model is proportioned according to what their goals and objectives are, and I saw that I could do the same thing as a registered investment advisor and really not have all of the bureaucracy and problems that you can sometimes have at a big brokerage firm. And I felt that these firms were very discredited during the bear market that we experienced. I mean, you have firms that really came out with terrible advice, and I did want to separate. I mean, I had continually sold myself on my own research and doing my own research, and it was kind of like, well, why was a firm recommending Enron or WorldCom or whatever the disasters were? Anyways, so I just could see that going to an independent format firm, an RIA, was the way to go. And the great thing about it is that I could go to my clients and I could say, well, this is what we're going to do, and it's going to be exactly what I've been doing for you for the last 10 years, but by the way, I can do it for less money. And, it was really dramatically less. So when I formed my firm, which was in 2005, it was pretty seamless. I just took a list of clients that were working with me that had pretty much what I call my model portfolio, and I used Charles Schwab Institutional as a custodian and set up my own firm. So that's kind of the whole story.
Okay, well, thank you. You said you started out as a registered rep in the 1980s. Was it that you wanted to employ technical analysis, or you wanted to be a registered rep? Was there a primary driver?
Well, back then, I mean, when I first started in the business, my undergraduate degree is in the sciences. I was basically pre-med, and I didn't really realize the interest that I had in the markets and in business. After I graduated, I moved out to the West Coast, and I just started taking some night business classes at the Graduate School of Business at Cal State Long Beach, and I just really found I was very interested in it. And at the time, I was in pharmaceutical sales, so, which was a fabulous job, but I found that my interest was really not there. And so, what's your question? I didn't know a whole lot about the stock market, and it was going through the Merrill Lynch training program, and the more books I read, and I think I really enjoy reading historical market books, and it was an evolution. So I didn't start out being a technician. It would have been nice. I think you can save yourself a lot of pain the better you get as a technician, although the market is forever challenging. And so becoming more and more involved in technical analysis was really a process. And it's something that, like I say, every day you're learning.
You certainly are. You indicated you started in the 1980s, and it was a wonderful time to start. And I don't mean this in a bad way, but I think you're coloring your memories through the stock charts. It was near a bottom when you started, but weren't people's attitudes pretty similar to now? Stock market's very risky. I don't want to be invested in stocks. We had the death of equities cover, I think, in 1982, actually, on Business Week.
Exactly, and you're exactly right. And you know what? Okay, I think I was 24, 25 when I started. So, and back then you try and look old to have, some credibility. But the thing that was so unbelievable about that time, you're right, you couldn't talk people into buying stocks. But you know what? You could sell bonds all day long. And I started out pretty much selling a lot of zero coupon treasuries, which were unbelievable. You had, when I started in the business, the prime rate was double digit, and you could buy California AAA municipals for 12%. So actually new clients that and it was back then, you basically cold called, and I was never a great salesperson, but the objection I would always get, well, I have a 12% AAA, California municipal, that would be, a name recognition. And they go, well, I'm really waiting for rates to go up to 13%. No, thank you. So, I mean, that was kind of the business back then. I did a lot of bond business, a lot of municipal bond business for pensions and so forth. And I do remember recommending you could buy AAA utility bonds that were at a 50% discount to their face value that were yielding 12, 13, 14%. I'm talking about Southern California Edison bonds, Pacific Gas and Electric, because those bonds were issued in the 1970s at much lower rates, and interest rates went up so high, people had their capital just cut in half. But that was a tremendous opportunity. Now, that was something that was very, very difficult to sell. I did have a few people that went along with me, but I mean, it kind of shows somebody would not buy something that they could lock in a guaranteed yield of 12, 13% with the 50% discount from its maturity value. And hey, investment grade, the phone company, AT&T, it was just incredible. And I think that goes to your point that the individual investor was very, very skeptical of the market. They did not want anything to do with stocks. And interest rates, the big thing was putting their money in the savings and loans for big double-digit rates. And then we remember what happened in the late 80s with all the savings and loans that went under because of the real estate debacle that happened back then. And there were a lot of people that lost their money. So it always goes back to the same thing. What is the public doing? And you're right. And I'll never forget, in the late 90s, people wanted tech stocks. They wanted internet stocks. They wanted nothing to do with value stocks. And yet, had you invested in certain sectors of the market during that big bear market of 2000 to 2002, you did very well in value stocks, and of course you lost your shirt on the internet and anything technology related.
So we find maybe that the attitude of the typical investor was pretty similar. Do you think this would still be a viable career choice for a young technician to go into registered rep?
Yeah, I mean, what's changed when, when I look back, I mean, you figure, well, interest rates were double digit and the stock market was at 1,000 and, how could you go wrong? And then you look at now where we're at, and of course, things are different, and you look at the bond market with interest rates at these historical low points. And as a young broker, what do you do? And so I think absolutely technical analysis is a growth industry, and I would recommend anyone that has a firm grasp of technical analysis, where you're going to make your money is really seeking out opportunities. And I think you have to be very, very careful. I think your point's well taken that the individual investor seems to be very much in the one-sided trade of the bond market, which I think, you've got to look at it with some skepticism. So the business is very different than it was 30 years ago. And we're seeing a big, big transition away from big firms, the registered representative or stockbroker, to more of an independent advisory type of relationship that is fee-based. And to me, when you look at the big firms, they just seem like they're dinosaurs.
Yeah, I tend to agree with you, but I still think for somebody starting out, the big firm might really offer a viable path that's been overlooked to get training, experience, and kind of a leg up with some income. Like you said, when you made your transition, it was easy to show clients a track record.
Right. And I think as far as like what does somebody do right now and you can go to the big firms. The problem is if they don't have the training, and that's a tough way to go too. I mean, you do have to really sell whatever it is that they want you to sell. And so the key to being a successful registered representative at a firm is just to make sure you sell what is going to be the best for your clients. And if you do the right thing for your clients and you do a good job, what happens, referrals, all of that accumulates, and that's how you do grow. I think you can start out a couple ways. I think going the route of the big firms, although there's very few firms, and it's my understanding it's very tough to get into the training programs. There's not any of the training programs that are in existence like when we started in the business. The other option, because the registered investment advisory business is growing so fast, going as an apprentice with one of those firms, I think would be an excellent idea. And you'd probably be doing that as a marketing person. So that would be an excellent way to go. And that's really, the other thing is it depends where your interest is. I mean, you can get your financial planning degree. Investment advisory firms, you're basically going to operate either by giving investment advisory services or financial planning or wealth management.
And you indicated that probably one of the best entry-level jobs would be to keep your mind open to a marketing position.
Right. I mean, we see, and we've talked about this. I see tremendous guys that have a very firm grasp of technical analysis and are very good in maybe trading their own account, just really so far ahead of the game. But it's a question, how do you get a job or where do you get a job? And if you want a job in the investment management industry, let's face it, you have to know how to collect assets. You have to find people that want to give you their money for you to manage, for you to give them the advice of what to do with it. And that's the first step. So being in the industry for, it's been almost 30 years for me, it's an industry that does require different skills. And sometimes you can have very, very good salespeople, or they're able to really do a great job of convincing people to invest with them, but maybe they don't have a clue as far as what to invest in or the mechanics behind finding a good investment or knowing when to sell. I mean, there's so much there. So you have to not only, and I think each person has to ask them, well, where is my expertise? And our friends here at the Market Technicians Association tend to have a passion on the markets. they tend to, they're going to be very into improving their skills and being great technical analysts. And that's what they have to learn to sell, because they are going to do a better job than many of the money managers out there. But you just do have to know how to market yourself.
And then, do you think it's different when you're managing other people's money as opposed to trading your own account?
Absolutely. Absolutely.
From the compliance and regulatory perspective in particular?
Absolutely. You have to, and as an investment advisor, you have a fiduciary responsibility too. There are several things. First, you have to find out what does this person want to accomplish. You really have to find out what are their goals and objectives. And it's one thing to trade your own account and have your own risk profile, but really, if you're an advisor, you need to know what is this client's, what is their objective? What are they looking for? What is their comfort level? And some people have a very low tolerance for risk. So that's another aspect that you really have to be able to figure out, what is this person looking for? How can I best deliver what it is they want to achieve? And your personal objectives may be very different from someone else's.
Also, in my experience, the average investor tends to overestimate their risk, and your job at times becomes part psychologist or counselor of some way.
Absolutely. And that's a good point, Mike, because, just going back, and you remember this too, going back into, I remember going into the year 2000, there were people that, oh, well, I need to get a minimum, huge double-digit rate of return per year, and nothing else is acceptable, and I'll only put my money in technology and so forth. And those are the kind of instances that you just have to tell people it's not realistic, and and no, that's too much risk, and those are all things that you have to have a firm understanding of. And because what goes back to what you were saying originally is investors they wanted the easy route. Like right now, they don't like stocks. They like bonds. And when things are really popular, a few years ago was I'm just putting my money in real estate and owning all these separate homes or whatever. So throughout the years that I've been in the business, and I really enjoy history of the market, a lot of bells should go off when you see the general public doing having their assets concentrated in one particular area.
Okay, so the job then is part sales, part psychologist, part administrator, lots of other things, and you get to do some technical analysis? Right.
As an investment advisor, it's so great because you are managing money on a discretionary basis. So basically, on the one hand, to me, that's very liberating. To other people, it might be daunting and very scary. But that's where the use of technical analysis comes in. Hopefully you have a better perspective of where the risk rewards are in the market and really helping your clients get having a good return, but of course reducing risk. That's the name of the game. And I think that kind of strategy creates success long term if you can execute it. So yeah, there's a lot of things to do, because how do you do the market research, have the time to do all the technical analysis, and then administer the accounts, market your services. Of course, you have compliance. You do have to adhere to tremendous compliance guidelines and everything else that there is to running a firm. But I think, and it depends, and I guess to not make it too complicated, you can set up your business to reflect what your expertise is. And I know there are money managers out there that are very good at maybe focusing on more aggressive momentum type areas, and then they're dealing with more aggressive clients. And likewise, there's other investment advisors that are very conservative that maybe focus on really conservative, high-quality blue-chip stocks and covered call writing, more of an income. So those are all questions you have to ask yourself. But it's your own business. You, like any business, it takes a tremendous amount of time, and it takes work. But once you develop a clientele, and if you're successful at what you do, it's something that's cumulative and grows exponentially because referrals follow.
Well, yeah, I know we just scratched the surface, but we need to wrap up here. Maybe we could come back and do another call specifically on setting up your own company, and then maybe another one after that even on the specifics of the technical analysis system that you use or strategies that you use.
Sure. That would be fine.
And is this something you'd recommend for someone to look at wanting to build a career in technical analysis?
I would. It's the one career. I mean, you have your own business, and what appealed to me about this business when I first started out is there's no cap on the upside, and you can make it as successful as you want. So it's really wonderful, and obviously people in this association are very passionate about the markets and technical analysis. What could be better than making your living doing this? So it's just every day, every day there's something new going on. Every day it's a new challenge. And it is a wonderful career. If your interest is in that area, if you want to work hard, if you want to make a lot of money, I mean, it can be the whole gamut. It's definitely worthwhile.
It is exactly what you make of it. Thanks so much for bringing this career maybe to the attention of some people and for sharing so much time with us today.
You're welcome.